All right, welcome back to another episode of the Making Moves in Multifamily Live show with Tim and Tim. I'm so glad to be back. Feels like it's been a while. Uh,
It has been.
it, it has been. It has been some time. This is the first show that we're doing in 2025, and I thought it was going to be rightfully just to talk about the potential tax changes for real estate investors that are potentially could be implemented within the next 106 days because Trump comes into office 6 days from now and he has a 100-day executive order window to implement a lot of things. So, Tim, how you doing, man? You look fresh. 2025, everything looking good, man.
I look fresh. Thanks. I am doing well. I'm glad to be in 25.
Yeah,
Glad to be alive in 25. Let's play with that, right? Like,
yeah. So that's good, man. So, all right. So this is obviously we are not. I feel like this is dumb that we have to preface this, but obviously we are not your CPA. I'm just pulling information from the internet and Twitter and things like that that I have found that I thought was interesting. None of this has been implemented as of this point in time. It's all hypothetical. But I just thought it was interesting because, Tim and I being in the real estate investment world and have raised over $60 million of investor cash, a lot of investors talk to us and turn to us for investment and financial advice and staying current on political changes, tax changes, the lending environment, insurance environment, all of those things. Those are the intangible things that Tim and I consume ourselves with that nobody else sees, right? It's what we find interesting and how we keep up with what's changing on in our current economic environment to make good decisions for ourselves, and good decisions for ourselves are also great decisions for our investors. That's why people trust us to invest their money with us. There's three things that I'd like to talk about today that I think are the biggest impacts to real estate investors. Um, and it's proposed changes to 1031 exchanges. And then we have capital gains adjustment tax changes that are being proposed. Oh, balloons. Look at that. Yes, balloons. And number three, bonus depreciation and interest deductibility. I guess that's kind of three and four, but they kind of go hand in hand. So we figure we put it into one. Um, so the first proposed change is the Biden administration proposed for 2025 tax year that they would they would cap the tax gain or the tax liability deferment through a 1031 exchange to $500,000 per taxpayer annually if you filed married jointly. If you're married, filed jointly, it would be $1 million per year that you can defer in tax gains. And I I think that that's big because
yeah,
nobody has ever, at least in my awareness or that I'm comfortable saying on this show right now, is that I don't think that anybody's ever proposed a cap on a 1031 exchange because it's either you get some of your money and you pay taxes on it, or you get none of your money and you defer it all and you invest it into the next investment. Now, I know there's technicalities there where you can do like partial 1031s and all this other kind of stuff, but let's keep it simple for this show just so that people can grasp. Um, so the Biden administration, we talked about with the 2025 proposed caps on capital gains for 1031 exchanges. The Trump administration wants to remove that and say that you should be able to 1031 with no cap.
yeah.
Tim, how do you feel about that?
I don't have a problem with it. I mean, quite frankly, I don't like caps. For the most part, I don't like caps on things. Specifically because I think when you uncap them, it provides more incentive, right? So
Correct.
I tend to, for something like this, I tend to like it because the uncapped piece, because I mean, quite frankly, it's a tax investment strategy basically that you're kicking the can down the road, right? And I mean, let's be honest, when you lock your money up in a 1031, it's locked up. For all intents and purposes, it's locked up. So I get it, right? Like I understand what they're trying to do here. Like Biden's trying to create more taxable income for the federal government, which we can all go talk about that another time. But at the end of the day, I'm like, maybe there's other places to look for that kind of thing. Um,
Mhm.
don't take this one. And I'm not saying don't take this one from a real estate investor standpoint, because remember, there's different types of ways to roll money over. It's not just real estate that this necessarily impacts, right? So, um, from a real estate standpoint, I'm like, if I make $1 million on a deal and I want to roll that into the next deal and I'm willing to roll it in and not touch it, why shouldn't I be able to do that? Like,
Mhm.
you should incentivize me to invest, right? And that's one of the things I like about the 1031 is it incentivizes investment, right? And I think that's a good thing. So yeah, I tend to like this one. I never agreed with the cap in the first place. And regardless of Democrat or Republican, I just, I didn't think this was the place to go find it. Right.
Yeah, I don't think that it's good for the economy to kind of put that cap there because you're right. If I'm not going to touch the money and I'm just reinvesting it into another deal,
Yeah.
you want that to happen. Like you want for growth of a community, for growth of an area, you want people to sell deals and buy deals and incentivize them to invest their money because there's so many other ancillary companies that make money through transactions. And to me, that's economic stimulus. But by injecting money, by doing deals, you are injecting money into the economy because somebody else is making money and getting paid and providing salaries and benefits and all that kind of stuff to people that are doing the work. If you stop, if you don't incentivize trading of assets, all of those ancillary companies that take part of a transaction lose their income, and therefore you start to have more layoffs. And I just don't see it being a good thing. The 1031, it's a great incentive for people to continue to grow and scale their portfolio. And some people might look at that negatively, but I look at that as it opens opportunity for people to get started. And what you might be saying, Tim, what the hell are you talking about? It enables people that own smaller properties to 1031 up into a larger property, which by definition means that somebody is getting their first opportunity into a smaller deal. If the guy or girl, sorry, never sold their small property to begin with, there would be no opportunity for other people to get started in the industry, right?
Yeah.
Like it's cyclical. You start with small stuff, you graduate to larger stuff, and it continues to grow and grow and grow. Well, you have to be able to sell smaller deals to enable other people to buy smaller deals to get started themselves as well.
Right.
So I'm a big fan. I mean, I've never used a 1031 in full disclosure, but I can see the value of them and the benefit of them. But I have never had to use one myself.
Yeah. Yeah. Cause, and I think you're hitting on a key thing, and somewhat related to this, right? Is, people are going to look for ways, regardless of what's available, people are going to look for ways to shield their gains, right? They're gonna look for ways to try to offset any kind of impact to what they've earned. It's just the nature of things, right? So, in my mind, what this does is if you cap it, I think you end up with more people who end up doing long-term hold and refinances, right? So I'm just going to refinance it, pull what I can out tax free and go use that elsewhere. Um, but what Vitali mentioned there is what that doesn't do if I refi it, it doesn't bring product to the market for somebody else to buy, right?
Right.
It and not a bad thing. Like, I'm a big believer in the BRRRR strategy, quite frankly. But I also am a believer in transaction and turnover, right?
Mhm.
I mean, look right now. We got issues right now with the real estate market frozen in the single family space, right?
I was just going to say that. So,
Yeah.
some people are locked out of buying a house because interest rates are too high and they can't afford to buy what's on the market because there's not that many transactions happening. So, what is on the market is still very expensive.
Right.
Conversely, there are people that want to trade their houses and want to do some things, but they're locked in to a low interest rate. Therefore, they're not selling. Yeah, right. They're not going to sell their house because they don't want to get rid of that interest rate. So what that does, it really puts a constraint on supply and continues to drive prices up. And depending how you look at it, that could be a good or a bad thing. But
Yeah.
I think by capping capital gain, by capping incentives that incentivize you to do a transaction reduces the amount of supply on the market and therefore keeps prices higher longer.
Right. Yeah. No, I completely agree with you, man. I don't think this is a good one.
No.
And what I would say is, this is probably one of the places where I support the incoming administration's plan. I'll put it that
Yeah.
way. Um,
So, all right. Next thing I want to move over to is bonus depreciation and interest deductibility. Um, okay, so the current bonus depreciation, everybody's familiar with cost maybe not everybody, but most people are familiar with cost segregations and bonus depreciation, and that had been a enormous incentive for people to invest into real estate to get the write-offs to shield their income so that they didn't have to pay taxes on it. That's the incentive to investing in long-term illiquid assets is the tax benefits. Like that's a known thing. The current schedule, it was 100% bonus depreciation up through 2022, and then it was phasing out over 5 years. So it was reducing 20% per year starting in 2023. So it was 80% in 23, 60% in 24, et cetera, and so forth, right? So all the way down, it would go down to zero, and then you wouldn't have bonus depreciation. You could still do a cost segregation, which puts everything in different useful life buckets, but you wouldn't be able to take that initial write off in year one, which can be very, very, very helpful for a lot of investors. I know it has helped me out a ton by
mhm.
shielding taxes. So Trump wants to come in and he has proposed that he wants to get rid of the phase out schedule of bonus depreciation. And he wants to make it a permanent thing where 100% bonus depreciation is eligible in year one of purchasing an asset. I love that. I mean, that is something like I saw that and I told my wife, I say, hey, Danielle, if this happens, we're probably never going to pay taxes again because I will always roll the money into something else. I'll get that bonus depreciation. I could 1031 it into something. I could refinance it and pull my cash out and have that depreciation and continue to roll it forward. A lot of people say when you play the depreciation game, you're robbing Peter to pay Paul until you die. Well, then, hey, that's what's going to happen for me. I'm going to play it till I die and, and never plan on paying taxes ever. And as a real estate investor, that makes me really excited. If you're somebody that doesn't invest in real estate and you want to get invested in real estate and you just have a W-2 job right now, you might be infuriated by that statement because how much money you're paying in your W-2 taxes. But this is one of the reasons why I got into this industry because I love this benefit of investing in real estate.
Yeah. And guys, keep in mind too, by the way, that just one thing, I know it's not quite the same, but I had somebody the other day who was like, you're not paying taxes. I'm like, no, I am. Let me show you the
Yeah.
tax bills we pay every year.
Yeah. I'm
Um,
probably paying more taxes than you in other ways,
right.
not through my income, but through all the property and value. I mean, hundreds of thousands of dollars in taxes we pay every year, right? But
Easily. Yeah.
easily.
Yeah. Um,
Um, so that big fan of, 100%. If they make 100% bonus depreciation permanent, my goodness, I think that is really going to incentivize a lot of people to do some trading of assets
yeah.
because they're going to want to scale up. They're going to want to realize gains. They're not going to want to have to lock their money into a 1031. I personally have never done that. I just use depreciation that's been built up to
Right.
offset and then reinvest the money. Then that reinvestment is a higher leveraged, higher, bigger deal. I get more bonus depreciation year one. Then it all nets out. Right. And then I have this bonus depreciation sitting there so that I can sell some of the smaller stuff, which creates transactions. And then I can reinvest that money into a bigger deal and shield those capital gains from the tax depreciation that I got from the other deal, right? So
Yeah.
it's playing leapfrog, right? You never really stop doing that game, and you just have to be conscious of what you're doing and when you're doing it, so that you can ensure
Yeah.
that you have the depreciation to offset your capital gains.
Yeah. And I think people miss that part of it sometimes, Tim, is like the bonus depreciation. Like one of the issues with it scaling down, right? Going from 80, 60, 40, 20, 0, right? Is when we took 100%, right? Well, 2 years later, it's at 60%. We have that recapture event, right? It's
Mhm.
hard to offset. This starts to become hard to offset that recapture. So then you start thinking more and more about, do I want to sell? So,
Mhm.
like, we're back in this problem, like we talked about with the 1031. If you cap it, it's like, do I want to sell? And, a lot of these things are really built to spur investment, right? Spur investment, spur transaction, because what keeps the real estate market moving is transaction, right?
Mhm.
Otherwise, I hate to say it, guys, but otherwise, what ends up happening is a very small group of very large companies end up owning everything, right? And you want to create opportunity. You see it in a much smaller scale, right? In the residential market, where the younger generations aren't able to buy for all these problems that we've talked about, because it's been largely frozen. You got a supply issue, you got a demand problem, and the market's frozen. So,
Mhm.
you bring this up to the commercial space as well. You start to see some of these things, right? And I mean, we've had a ton of people come to us over the years and say, where am I supposed to deploy it? And I got to recapture and all this other stuff. And how do I offset it?
Yeah.
Well, here you go. This will help with that.
Yeah.
Um,
Yeah. And then and another thing that kind of goes hand in hand with the depreciation is the interest deductibility. I don't think a lot of people know this, but right now it's capped at 30% of your adjusted taxable income. So for example, if you pay $100,000, if your adjusted gross income is $100,000, and because you played the tax game well, you had a bunch of write-offs, you had this, that, and the other thing, but interest on loans is looked at differently than expenses. Okay.
right.
Even though it's the same cash out activity, they understand that you're using it to leverage to get up, to buy a larger asset, to get bigger write-offs, et cetera, and so forth. I mean, they're not stupid. Um, but what most people don't know right now is that's capped at 30% of your AGI. So if your AGI is 100K and you pay interest of $50,000 on your loan, you're capped out at only writing off $30,000 of that interest, and the remaining $20,000 will roll forward to the following year until your AGI goes up, right?
Right.
So that is it is something that people probably don't pay attention enough to. It can affect your cash flow and your taxable events and things like that. But that is something also that they're looking at rolling back so that there is no cap on your write-off of interests.
Yeah, I was just sorry, probably getting off on a tangent here a little bit, but I was just thinking, I think that actually creates a double taxation of it. Not for you, but on that same money. Because if you're paying that cash and then you're taxed on it because you're limited on what you can offset, right? So you spin it, you send it off to the bank, right?
Yeah. Yeah.
Well, the bank's getting taxed on that income as well.
Oh.
Yeah,
Hmm.
because it's
I hadn't thought
profits
about
to the
that.
bank. Profits to the
Well,
bank,
you come
right?
from the banking world, so of course you would think about that.
Yeah, I mean, it's profits to the bank, so they're being taxed on it when they receive it.
Yeah. Well, what's interesting is, on the Twitter X space right now, there's been a lot of proposals of abolishing the IRS and the taxable income brackets and just making a consumption tax instead of an income-based tax. That of which I know we weren't saying that we were going to, I didn't think we were going to cover this, but I am not a fan of that at all. I love the way that the tax structure works for me right now because of these real estate incentives. If they went to a consumption tax, nobody's shielded from paying taxes because it incentivizes people to save money and not spend money, which I think is terrible for the economy. But it says, if you were out to, if you didn't make as much money as I did, right, and you went out and bought a Toyota Corolla, and I went out and bought a Lamborghini, your taxable expense of, I think it was 23% is proposed on your $30,000 Corolla is times 0.23 is $6,900. That same thing, if I go out and buy a Lamborghini for $300,000, my taxable consumption tax is going to be $69,000 on top of the purchase of my $300,000 car. And that would be rolled out across the board with everything. They're talking about abolishing like estate tax and tax brackets and everything, right? And it would just be a consumption tax. So every time you go buy something, think about it like the Great Britain's VAT, value add tax, is 20% on top of anything that you buy. Any goods, is it goods and services or just goods and excludes services? I can't remember. When I worked in the insurance world, we had a branch in the UK, so I knew a lot of those rules. Can't remember what they are right now, but not a fan of that proposal. So I hope they don't pass that one.
Yeah, I got to be honest. I don't have a problem with the whole Corolla Lamborghini scenario, but what I do have a problem with is tax and consumption, because it doesn't spur investment.
It doesn't.
And in fact, it discourages consumption. I mean, hey,
Correct.
we can all have a chat about if we overconsume in this country. I mean, that's a conversation we can have. But at the end of the day, you know, companies are built off the idea that people consume,
Yep,
right? I
exactly.
mean, the
Yeah, you
the
cut the
banks,
demand and the
right?
supply goes up, everything drops.
Yeah,
Yeah, macroeconomics, supply and demand is rules everything.
yeah. The banks, Lowe's, the restaurant you go to, they're all built off the fact that there are customers that want to consume their products and services, right? So, um, if I'm paying 30% to go eat out or buy a piece of lumber, then I'm probably thinking twice about how often I do that. Um,
Mhm.
you know,
Yeah.
that's just my thought, at least.
Yeah,
Um,
I think most people would fall in that bucket. They're gonna be taking home more money, not making more money, taking home more money, but they're going to be spending less because the drastic shift of going to that tax strategy, I think
yeah.
it's gonna be a really tough pill to swallow for a lot of people
Well,
because
and
they're gonna
yeah,
think I think it might be difficult for people to calculate, well, what is the true cost of everything that I'm buying? Because you have to add such a large amount on top.
yeah. Well, and then too, I mean, I don't know. I mean, I'm sure there's a lot of intricacies that we aren't talking about here, but
Mhm.
like, I mean, there are certain things that I go purchase, right, as a consumer because it does create a tax offset for me. So,
Yeah.
um,
Yep.
I don't know.
Exactly. Yeah. There again, talking about it, limits the incentive to do transactions. And if there's no transactions, nobody's making money.
Yeah. So,
And yeah, that's what keeps the economy going. So, all right. Last thing I want to talk about capital gains tax adjustments and how does that affect you or does it at all? So first thing, capital gains, we have long-term and short-term capital gains. Short-term gains are if you own an asset less than 12 months, 365 days. If you own it less than 12 months, you sell it and you will be taxed at ordinary income tax rates, which depends on your tax bracket. Whatever your payroll taxes are, it's similar. It's the same tax bracketry. Goes up to 37%, right? So there's a very large incentive for people to hold on to assets for a year and a day so that they can go from a 37% tax rate to a long-term capital gains rate, which is broken up into 0, 15, or 20% rates. The 0, 15, and 20%, they also have different income brackets, right?
right.
So your income tax, your capital gains tax could be taxed at some, and I did look this up, so I do know that these numbers are correct. As of 2024 tax year, married filing jointly, if your AGI is less than $94,050, so 94K, married filing jointly, your long-term capital gains tax rate is 0%. If you make between 94,000 and 583,000, your capital gains tax rate is 15%. And if you make over $584,000 for 2024, your long-term capital gains rate is 20%. Those are all married filing jointly numbers. If you're a single individual that, files a single 1040, just cut it in half, right? I mean,
Yeah.
roughly that'll get you close enough to the numbers. I think there's, $25 or $50 swings either way. Proposed for 2025, those are all married filing jointly rates went up. So 0, 15, and 20 went from 94,000 to basically 97 for 0%. For 15%, it went from 97 to 600,000, and 20% is $600,000 and over. And comparatively, 2024 is $584,000 and over for 20% married filing jointly. So those are huge impacts
Yeah.
to your capital gains taxes. And I have to be honest with you, Tim. I think I sent you like a text message a week or two ago when I was texting our CPA that does our tax returns. I saw it on Twitter and I was like, wait a second, there's a 0% long-term capital gains rate. And I sent it to Mark and I was like, Mark, how do we do that? He goes, you're already in that bracket. And I was like, no way. So very happy about that.
Holding everything for 366 days.
Yeah, 366 days it is. No question about that. But obviously there's a push to own things long term. So it's kind of contradictory to everything we were just talking about, like incentivizing transactions. This incentivizes holding, but I don't think that a year is a long time. I think most
No.
people think on paper it looks like a long time. The first year of ownership of a property can fly by in the first year
Yeah.
because you're doing so much, like with renovations and lease turnover and capex projects and things like a year goes by in a blink of an eye when you're
Yeah.
owning and managing an apartment complex.
Yeah, yeah. I mean, and quite frankly, guys, a lot of us are doing value add anyway.
Yeah, right.
So most value adds that I'm seeing take 12 to 18 months, right? Anyway,
Mhm.
so on the low end.
Yeah.
Um,
So
so
the Trump administration, they want to reduce the bracket. They want to change the bracketry a little bit more so that it makes it easier for people to get into lower tax brackets. The Biden administration, their 2025 plan proposed to make the brackets lower so that it's harder to stay in those brackets so that you do pay more tax. Obviously, my favor there is to make it easier to hit that window so that I pay 0% taxes on my long-term capital gains. And let me tell you, um, when I first got into the real estate industry, there was a lot of people that, the number one thing that you have to learn how to negotiate with a seller is everyone's problem is, well, I don't want to pay taxes on all of that. Well, the more you know about taxes and the more you know about these strategies and these different, tax brackets and things like that, the more it enables you to think creatively to solve a problem for somebody else to help them avoid these taxes because you've done the research, you understand, you've invested your time and energy into knowing these things, and you should get the economic benefit of being able to do these deals because you know these things, right? It's
yeah,
personally, I call that low-hanging fruit. If you're not willing to go after the low-hanging fruit of researching economic impact of taxes and how it affects real estate, then you're probably not meant to be in the real estate industry.
right.
Gosh, I know I'm excited when I'm talking fast. I get super pumped and fired up about this kind of stuff. I did come from an accounting background, so I didn't do taxes. I did like corporate GL accounting and stuff like that. But I have a better concept, a better knowledge and understanding than most people do when it comes to taxes because of it. So it's obviously it's very, very, very important. If you're going to be a syndicator or even doing deals as a JV, like your investment partners, they're going to want to know like tax incentives and are you staying current? I mean, you're getting paid potentially some sweat equity there to know all these types of things and be the point of contact. So it's in your best interest to know these types of things.
Yeah, agreed. So, know this stuff, know how to utilize it, and make it work to your advantage, guys. Like, I mean, this is part of the reason, Tim and I got into real estate, right? Is this kind of stuff. I mean, just part of it, other than the fact that we genuinely enjoy doing it.
Mm,
Um,
yeah.
but man, I really do I like working hard and I like keeping what I earn. You know what I mean? So,
Yeah.
uh,
After what, 3 decades of paying taxes to the man, I had enough of that, didn't you?
yeah, man. I always share that one. Like Sarah and I had a year where we paid 3 times the average median income in this country 1 year in taxes. And
Oh,
yeah,
oh,
I
dirty
didn't
word.
enjoy that. And we're not, at the time we weren't millionaires, so that hurt.
Yeah, right,
Um,
exactly. Especially when you see it on paper and you're like, damn,
really?
I work, that was one of the things when I read Rich Dad Poor Dad, and he made the equation there. Like, if you're in the highest tax bracket and you pay 40%, right? So it's 37, whatever. You pay 40% in taxes. You essentially work January to May 31st to pay the government.
Yeah,
It's like, what?
yeah,
I don't want to do that. And coming from the accounting world, you have year end and Q1 closing in that first 5 months. It is the worst 5 months of the year for somebody that's in the accounting industry. And you're just like, no way, I'm not doing this anymore. I don't want to work during this period just to pay Uncle Sam taxes and I get to keep the rest. No way. This doesn't work
yeah,
for me.
yeah. So get out there, utilize these strategies, understand what's on the books, guys, and figure out how to make them work to your advantage.
Yeah. So, all right, guys. Thanks again. Appreciate you joining. Great to see you all. We will be tuning in regularly. If you didn't know this, with the Tim and Tim show every Tim and Tim Tuesdays at 10, right? That's how I remember it. My wife made me do the alliteration, and now I can't forget it because of that. So, appreciate you tuning in. Hope you learned something. Let me know your thoughts in the comments about what you think could happen over the next week, and then 100 days after that for executive order changes for taxes and real estate investments and kind of curious to see what happens, over the next couple
Yeah.
of months. So hopefully it's to our benefit because it's been difficult the last 24 months.
Yeah, we'll see.
So,
So,
all right.
all right,
Peace.
guys. Peace.